I'm Deborah Borchardt, and this is your midday market update. Well, we've really got mixed markets right now because the NASDAQ and the S&P 500 both up very nicely. The Dow is down just a tad, but it looks like it is trimming those losses. Our top headlines for today, well, GE powered up with some very strong earnings. Google ad volume up, and the stock hit $1,000 a share for the first time today. In Chipotle, they missed on their earnings, but their sales were red hot, and so the stock is doing very well. But here's what's going on. You know what? The government shutdown caused some of our economic reports to be delayed. Well, on Tuesday, we're going to get the non-farm payrolls. So what is that going to mean for the markets? Well, joining me now is Peter Cardillo. He is the chief market economist over at Rockwell Global. So, Peter, you know, can we put very much weight into this non-farm payrolls that we're getting on a Tuesday after we've had this shutdown?
No, I don't think so. In fact, I haven't changed my forecast. I'm still looking for 166,000 non-jobs, and of course, total unemployment unchanged at 7.3%. Remember now that the effects of the government shutdown will probably show up next month. So basically, you know, I think it's going to be a non-event for the markets. But there's one thing that I think we need to look at very carefully, and that is the participation number. You know, we've been looking at that very closely over the past several months. In fact, it indicates that while the job market continues to grow, it's not really mushrooming out towards levels that would suggest that we could see monetary policy change anytime soon. In fact, the events of the shutdown, of the government shutdown, suggest that probably the Feds are going to stay on hold for most of 2014. However, I still hold out with my thinking that we're probably going to see a symbolic retreat in the bond buying program as early as December. Now, I admit that the odds of that happening are slim, and that the market seems to be suggesting that the Fed is going to continue with its bond buying program, perhaps till the second half of the year.
All right. Well, let's bring in the dollar, because you and I were chatting just a little while ago about the dollar and all this liquidity, and some people are saying that we could see the dollar just crash as a result of all this.
No, I don't think so. I think that, you know, based on present economic activity, we'll probably see the dollar trade within a 2 to 3 cent range, which means we, in terms of the dollar index, we could probably go a bit lower here. But I don't think we're going to you know, make new lows in the dollar index that we saw 2 years ago. I don't think that's going to happen because remember that that Europe is coming out of their recession, but certainly if you take the total amount of economic activity, that is the gross domestic product, it's probably not going to go much beyond 1%. And the other factor is that while China certainly is turning up, we're not looking at 10% growth. So we're looking at total growth maybe around 3.5–4%, which means we participate by about 2–2.5%. So I don't see that dollar really weakening.
All right, well, right now, certainly the Dow is not weakening, because as we were talking, it has now gone into green territory. So now we've got all our indices, it's firmly in the green, pointing up a nice way, hopefully, if we can end the day like this to go into the weekend. That's Peter Cardillo, and I'm Deborah Borchardt with The Street.